The S&P 500 heat map from yesterday shows that more stocks are continuing to fall even after some of the worst drops we have seen since 2022. And when we take a look at some of the latest news, there is suggestions that even with some rate cuts that are on the horizon, they may still not save the economy from an inbound recession. And in fact, what we can see, articles talking about in 2025, the stock market is going to be dropping around 32%. Now, we get these articles every single year, in fact, on a monthly basis. So this month, there are no surprises. And one thing that really caught our attentions is how when we look at the more recent data, we can see that US shoppers are keeping a watchful eye on their spending as there is a lot of uncertainty around the world. Now, what does this mean? Well, today we are going to run through 4 stocks that we have seen some crazy drops just over the last few months, and we're going to see, are they ones that we should really consider buying, adding to our portfolio as they are down to their 52-week lows. Now, the first one we look at is Ulta Beauty, now down 26% year to date over the last 10 years. However, if you have been a shareholder, you still would have outperformed the S&P up 290%. And we do note all-time highs not that long ago, in fact, in 2024 at around $574. We also do see a double buy rating. The hold does come from quant, and when we look at the forward PE, it does sit around 14.14. Now, when we take a look at this company, in terms of their latest earnings, what I really like to see is the fact that over the last 4 quarters, they have beaten management targets, so they have a 100% track record just over the last year. Now, we do note the more recent quarter that they are anticipating to release earnings, they are seeing a negative 8% drop year on year, but the subsequent 3 quarters, they are expecting that to turn around to a positive. And for those that do like to look forwards to the subsequent year, 2026, a 28.18 estimated earnings per share will lower down their forward PE to around 12.89. So again, depends whether or not you believe purely from that aspect. It does look to be a very strong buy, but we are going to run it through our valuation model. Some of the metrics that we really like about Ulta Beauty, well, just take a look at their free cash flow over the longer term. It has nearly 10 times just over the last 10 years, and that is expected to continue over the next 12 months. As always, with the free cash flow, we do want to see consistent increases on a year-on-year basis. In terms of sales growth, well, in fact, nearly double-digit every single year, other than the COVID year that we do see the drop of 17%. And even in 2024, they did have a 10% increase to their top line. And when we look at it from a numerical standpoint, they've nearly quadrupled their revenue just over the last 10 years. On top of that, what they've done, which is always very nice, returning excess cash to shareholder pockets, they've done share buybacks, lowering it from 64.7 million to 49.1. They don't even have that many shares outstanding, as we can see. ROIC looking very, very strong. Remember, this is one of our favorite metrics to look at. 10% or more to give us faith management are able to effectively allocate their capital. We're talking the high 30s and low 40s a year on year. That is a phenomenal metric that many investors will love to see. In terms of the margins, ideally we want to see around 16%. So whilst it hasn't been at that level, it has still increased from the 13% we saw in 2015 to the 15-16% over the last few years. And as long as they can maintain that level at a bare minimum, that does look to be healthy. And free cash flow margin above the 5% we want to see as a minimum, increasing over the longer term. And in the low teens / the high single digits, still looks very respectable. Then we move on to the final metric that we look at, the net debt to earnings before interest, tax, depreciation, amortization. This shows us the number of years it would take the company to pay off all of their debt net of cash on hand. 0.49 looking very strong. Typically we want to see below 3, that would be ideal. So this is looking very strong, and remember, this does correlate to the balance sheet strength. So far with this company, it does look good, and even though it has dropped, doesn't necessarily mean we should buy it. So that is why we put it through the valuation model. Today's episode, we get a value of $485. Remember, if you enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. How we get to the intrinsic value? Well, we run it through just one model today, the DCF model. And when we take a look at this model, as you can see, we have three different growth rates, a low, medium, and high. Now, to use the low rate of 4%, we can see here that is substantially lower than the average of 48%, as well as lower than just the more recent year of 32%. When we use the growth rate in conjunction with the discount rate, we get the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we get that 485 that we just saw as well. Now, what does that mean? Well, that is upside of 32%. For those that believe that is way too conservative, at a 6% level, we can see 564. That is upside of 54%. And at 8%, that would ultimately give intrinsically a value of 656. Some very nice upside. As always, these numbers are very subjective. You can grab a copy of this model by clicking on the pinned comment below, running in your own numbers, whether it's for this company or any other. Now, we want to be very conservative here just due to the fact, as we mentioned, with the consumers looking to spend less over the shorter term, it does give us an extra layer of margin of safety. So 4%, when we bring it through to the final calculation, as we said, we use an MOS level, 10% as a minimum, and we execute on that if it meets our three golden criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that, we'll buy up to $436. Then we keep going till it's near the current trading price, and ultimately in today's episode, it isn't at a 25% level just yet, but really not that far. We're talking around $3 shy, so you could argue between a 20 to 25% based on the estimates and judgments we just ran through. Now look, it is more towards the 25% level. Wall Street themselves do see some very nice upside of 27%. Their price target $468 over the next 12 months. As always though, do let us know your thoughts in the comments below. Do you see this one that is incredibly cheap and now is the time to buy, or do you think we do see more pain in the market, especially in this industry as well? Now, before we move to the next one, just to let you know, we've released our latest weekly article. If you want access to this or any other articles, you can click on the pinned comment below and start reading and getting instant access. The next one we're looking at is Lululemon. Now, this one just seems to go lower and lower every time we review it. It is 52% down year to date, absolute insanity. And when we look over the last 10 years, it has still significantly outperformed the S&P, up 552%. As we mentioned, at its 52-week low, and we do get another double buy rating with the hold from Quant. And when we look at the forward P, it does sit just above 17 at 17.35. Very similar then to Ulta. They have beaten over the last 4 quarters, which is always nice. It gives us faith when looking forwards at their estimates into the future. But what we notice here, a little bit better than Ulta. With the next quarter, they see double-digit growth, and they see that over the subsequent 3. So looking very strong. And as always, if they do meet their 2026 number, that forward P will come down to below 16. So historically and in the future, it does look good, again, if we can rely on those numbers. Free cash flow per share as well, we have seen nice growth, again very similar to Ulta Beauty, a 10x over the last 10 years, a little bit more inconsistent as we do see a massive growth from 23 to 24, but we also note over the next 12 months it is anticipated to continue to increase upwards. In terms of sales growth, again, double digit every single year. So the question you may want to ask is, do we believe that the growth will stop? Will it go from, say, 19% in 2024 to low digit 2-3%? Or do you still have faith that over the longer term, they will be able to keep this growth, not just historically, but also into the future? Numerically as well, we can see some very strong growth, in fact, around 5 times over the last 10 years. And whilst Ulta Beauty also did share buybacks, Lululemon, as we can see here, very marginal year on year, not very consistent either. ROIC, again, phenomenal. We're talking between the 30 to 50%, so looking very strong and pretty consistent as well. That is always what we do like to see on this channel. Consistency is always worth paying a premium, especially if you believe they can continue that over the longer term. Margins also look very healthy. We get a bit of operating efficiency, increasing revenue as well as the margins, and above the minimum 16% that we want to see. And on the free cash flow as well, whilst we did see a drop in 2023, always nice to note that it does rebound very healthily as well, 18% on a trailing 12-month basis. Net debt to EBITDA, in fact, much better than the previous stock. 0 over the last 5 years, 0 expected over the next 12. So an absolutely phenomenal balance sheet. Now, in terms of our valuation today, we get to around $320. How we get to this value as well, we can show you the 3 growth rates of low, medium, and high. Now in today's episode, we have wanted to be extra conservative. We've gone for a medium rate of 15%, which ultimately gives us an intrinsic $320. Now, on previous episodes, we have gone for around the average of 19%, so you could argue that maybe that is better reflective. That would give a much higher intrinsic value of $407. But as we do see the economy starting to slow down, consumers starting to pull back, maybe you could argue being a bit more conservative does seem a lot more reasonable. So at that 15% level, as we said, that does give upside still of 29%. But if you believe that is way too conservative, a 20% growth rate does give upside of 73%. So in terms of the 15% rate, with an intrinsic value, we still see a very nice margin of safety. At 10%, a buy at 288, at 15% around 272, and at that 20%, that is a buy up to 256. So we're still seeing, even after lowering the forecast to 15%, a 20% margin of safety. And for those that want to wait for 25%, maybe you will not have to wait too long. You would need to wait for around $250. So with ultimately a 20% margin of safety, Wall Street also see a massive increase to the share price at $405. They believe upside of 63% when we look back from a year to date. But as always, you will need to do your own due diligence and give us your thoughts as we are going through these stocks today. This then takes us on to Nike, where we do have a double buy in the hold from Quant. Again, another one right there at the 52-week low, down 34% year to date. Over the last 10 years, you would have underperformed the S&P, although we do see its all-time highs of $178 around 3 years ago. This one does pay a dividend just over 2% at 2.07, and when we look at the forward P at 22.6, that is marginally lower than the S&P right now that sits around 23. Now when we take a look at this, we do like to see this, as we mentioned, 100% track record over the last 4 quarters, but do notice over the next 4 they are anticipating double-digit decrease to the earnings per share, so something just to understand when you are considering this. And when we look towards May 26, the forward P will come down to just under 20. Now it does have a dividend, so we get a dividend safety score of 99, very safe, in fact the highest score obtainable, and we do get a nice high single digit increase to the dividend of 8.8% in November 23. Ultimately, this score does mean that a dividend cut does seem to be highly unlikely. In terms of the last recession, well, in fact, Nike increased the dividend during the 07-09 Great Recession. They had above average growth, negative 6.6 versus the S&P's negative 12, and they also outperformed the S&P, negative 36, with the S&P coming in at negative 55. Dividend growth, well, as we mentioned, nice increase on the latest one, double digit over the last 5, as well as double digit over the last 20 years. We also note with 22 years of consecutive increases, they are 3 years away from becoming a dividend aristocrat. We do like to look at dividend yield theory. It tells us a company is undervalued when the current yield sits above the 5-year average. So we have a severe undervaluation signal. Bear in mind as well, this is probably the highest yield they have offered over the last 5 years. And it looks undervalued with the forward P 22.7 sitting below the 5-year of 31.9. We do, however, note the consumer discretionary does sit much lower at 13.8, and as always, we never look at any of these models in pure isolation. Free cash flow payout below 60% every single year, always great to see. 48% expected over the next 12 months, so we would be surprised if we don't see at least a mid to high single digit increase in 2024. Free cash flow then, when we notice the increase over the longer term, we also have to see that there have been a lot of inconsistencies, but over the next 12 months, it is anticipated to have a marginal drop to the free cash flow. In terms of the sales growth, well, one thing that does really stand out in 2024, their top line was flat. And if you do incorporate inflation around 4% year on year, then in real terms, that is a decrease. And numerically speaking, we can still see over the long term, when you zoom out, it has increased on that 10-year period. Nice to also note that over the last 10 years, they have returned that excess cash. They have done share buybacks, but again, not very consistent and very difficult to tell whether or not they will be able to continue this with the amount of pressure that they have had. ROIC, though, very nice and consistently around the 20% mark, always great to see. And the margins, we do have to say on the operating side, it has been straddling around the 12% year on year. There has been no operating efficiency, but at least it has been above the minimums. And on the free cash flow margin, very nice and healthy, much higher than the 5%, double 10% just over the last 10 years. Finally, a very strong balance sheet as well from 2021, in fact near enough zero year on year, and over the next 12 months 0.06. No surprises why that dividend looks to be very safe, and as we said, balance sheet also looking secure. Now our intrinsic value of around $100 does also give a nice MOS. 10% a buy at $90, at the 20% a buy at $80, and at the 30% it isn't quite there yet, but really a dollar shy, so we see a massive margin of safety of 30%. Wall Street, their price isn't as high as our intrinsic value, but they still see 29% upside, price target of $92.48, so definitely one to consider. But as always, do also understand the risk with each of these companies individually, and let us know if you want us to do a more in-depth deep dive of any one of these so far, and let us know your thoughts, as each one of these today has had a very respectable MOS level, as well as a nice upside portrayed by Wall Street. We then move on to Starbucks, which continues the trend of a double buy and hold from Quant, again right there at the 52-week low. Yield now a well over 3%, 3.11, with a forward P at 20.55. We do know year to date it has suffered, down 24%. Over the last 10 years, you would have underperformed the S&P. Bear in mind, as we can see, all-time high does sit around that July 2021 at $126. Then in terms of their last earnings, well, probably the poorest out of the four that we have seen. 2 beats, however, the more recent 2 quarters, they have unfortunately missed, and they are expecting the subsequent 2 to be a decrease to the earnings per share. Now, when we zoom out to 2025, a 4.04 EPS estimate does lower their forward P to just above 18. When we talk about their dividend safety as well, if you have been watching these episodes regularly, you will note they were downgraded to a 60 borderline safe, and we can in fact see their dividend growth last year mid to high single digit. The 60 borderline safe score effectively means that they're moderate risk of a dividend cut over a full economic cycle. In terms of the last recession, well, no dividend paid, so there is no comparative data. They had marginal above average growth, but they did trail the S&P negative 69, with the S&P at negative 55. In terms of the dividend growth, historically they have had some very nice growth. Doesn't mean though moving forward that will continue, and we can see 13 years of consecutive increases. We then look at dividend yield theory, again severe undervaluation signal both on the yield, which does look to be the highest over the last 5 years, as well as the forward P, the lowest over the last 5. In terms of consumer discretion though, bear in mind that does still sit significantly lower. When we look at the free cash flow payout, as we said, below 60%. If you want to be restaurant specific, below 50. 2023 at 67. 2024 expected 71. Not the greatest. It has started to come up higher than we want to see. So don't be surprised if we don't get as strong growth as we have seen in the past. The free cash flow per share as well, as we can clearly see, it is very inconsistent. There is no trend over the longer term, and we do expect the next 12 months to be pretty much flat. In terms of sales growth though, that does look nice. Double-digit increases nearly every single year. Bear in mind that when we have uncovered their earnings report, they are expecting 2024 full year to have very minimal growth, if any. In terms of looking back though, in terms of the numericals, we can see they've more than doubled their top line over the last 10. And in terms of these shares outstanding, whilst they have done some significant share buybacks over the longer term, in the more recent period, it has been a very, very trivial amount. Then we bring your attention to the ROIC, which has been very strong and consistent pretty much across all of the 4 companies that we have reviewed today. And the margins very similar in fact to Nike. We do know it has pretty much straddled around the minimum we want to see. In terms of the free cash flow margin, looking healthy again, especially over the last 3 years. Finally, we get to the net debt to EBITDA, 2.06 in 23. Remember, below 3.5 for this industry. Expected there or thereabouts over the next 12 months. So again, not too bad, but maybe just something to keep your eye on. We then come to the valuation. Our intrinsic value of $94.51 is higher than Wall Street. They have around $88 price target over the next year. They see upside of 20%. Now, in terms of our margin of safety, well, 10% a buy at $85, 15% around $80.33, and at that 20%, not too far off the current trading price at $76. For those looking at a 25% MOS, again around $71, and we have seen that not too long ago. As always, if you did enjoy today's episode, smash that like button, hit that subscribe and bell button so you're continually notified of these videos as they drop. And as always, let us know your thoughts below. Are you adding to any of these 4? Maybe they're on the watch list, or for whatever reason you believe there is a lot more downside and you're not considering for the time being. As always, see you all on the next one.